Good morning, good afternoon, or good evening to all of you out there. Whatever time zone you were joining us from right now of Sip&Talk, we are absolutely thrilled to have you here today.
We really are. And to all our Sip&Talkers tuning in right now, you might want to grab a coffee or a notebook or just buckle up for your commute because today's information load is it is completely insane.
Oh, totally off the charts. We are tackling a topic today that Wall Street simultaneously obsesses over and completely dreads. We're looking at the ultimate fate of our current capital markets.
Right. And before we jump into the deep end here, let's lay down our standard Sip&Talk mission statement. Our goal on this show is always to cut through the daily market noise. We want to find the underlying structural truths and really promote independent critical thinking.
Exactly. And just a quick disclaimer up front for everyone, we are not financial advisors. All the data, the financial frameworks, and the geopolitical developments we unpack today are purely for informational and analytical purposes.
Always good to get that out of the way.
Yeah, definitely. So setting the stage for you all today is Tuesday, March 3, 2026. And if you look at the daily news cycle right now, you see Donald Trump pushing forward with Tariff 2.0 and various deportation policies.
Right, which objectively speaking, those moves are creating significant structural ripples across the labor market and baseline inflation.
Right. But while the media is hyper-focused on those daily political headlines, we want to look at the real tectonic plates shifting under the global economy.
Because what we're watching is a massive slow-motion collision happening right now. It's a textbook financial phenomenon known as a Minsky moment, and it is crashing headfirst into the greatest artificial intelligence bubble in history.
Which is wild on its own.
Right, and this entire precarious structure is currently being sparked by very real Iranian airstrikes in the Middle East. It is basically the definition of a perfect storm.
It really is. And it brings us to the ultimate question that every tech elite, every institutional investor, and probably you listening right now, is quietly asking behind closed doors. And that question is it too late to exit?
The billion-dollar question.
Literally. So to understand, if it's too late to exit, we first need to figure out what kind of trap we might be walking into. You mentioned the Minsky moment earlier. I know this is a classic macroeconomic framework, but for anyone who hasn't reviewed their financial theory recently, how does this model actually explain what we are experiencing right now in 2026?
So his term was actually coined by the economist Paul McCulley back in 1998, though it's entirely based on the life's work of Hyman Minsky. And the core, somewhat mind-bending premise of Minsky's theory is that financial stability inevitably leads to financial instability.
Wait, so being stable causes the instability?
Exactly. When times are good and the market is going up, investors and corporations get comfortable. And when they get comfortable, they take on more debt to maximize their gains. But eventually, that heavy debt load breaks the very system that created the wealth. Minsky categorized this journey into 3 distinct stages of financing.
Walk us through those 3 stages, because I feel like understanding them is crucial to diagnosing the health of the tech companies everyone is throwing money at right now.
Sure. So stage 1 is hedge finance. Think of this as the safe, boring stage. A company borrows money, but their cash flow from actual business operations is strong enough to comfortably pay back both the principal and the interest.
Okay, so it's like having a standard fixed-rate 30-year mortgage where your salary easily covers the monthly payments.
Perfect analogy, yes. But then stage 2 gets riskier. That is speculative finance. Here, the company's cash flow only covers the interest payments. They are not making enough to pay down the principal balance, so they're forced to constantly roll the debt over.
Meaning they're basically taking out new loans just to pay off the old ones.
Exactly. They're just praying that interest rates stay low so they can keep juggling.
Which sounds incredibly stressful to manage, but I imagine it gets even worse in the final stage.
Oh, it does. Stage 3 is the absolute danger zone. That is Ponzi finance. At this stage, the cash flow doesn't even cover the interest payments. The only way the entity survives is by borrowing even more money just to pay the interest on the previous money.
Wow, so they are entirely reliant on new cash coming in.
Right. This structure relies purely on the underlying asset continuously appreciating in value. If the asset stops going up, or if lenders suddenly just close their checkbooks, the whole thing instantly collapses.
You know, as our listeners know, Minsky's whole thesis reminds me of a high-stakes poker game. It is like raising the stakes on a terrible hand until someone finally forces you to show your cards.
That's exactly what it is.
And that terrifying second when the table runs out of cash and you have to flip over your garbage hand, that is the Minsky moment. But in 2026, where exactly is this poker game being played? Because looking at traditional banks, they seem relatively well regulated.
That is the thing. The poker game isn't happening in the brightly lit casinos of traditional regulated banking. It is happening entirely in the dark. The most frightening reality in the current financial data is the massive explosion of the shadow banking sector.
Shadow banking?
Yeah, we are talking about non-bank financial intermediation, or NBFI. Right now, these shadow banking entities hold over 47.2% of all global financial assets.
Almost half. Almost half of the global financial system is operating outside traditional banking regulations. How does that even work in practice?
Let's look at the private credit market, which sits inside this shadow system and has ballooned past $2.5 trillion. Instead of a tech startup going to a heavily regulated commercial bank for a loan, where the bank demands strict capital requirements, transparent audits, and proof of hedge finance, the startup goes to a private credit fund.
Ah, I see.
These funds pool money from wealthy investors and institutions, and they lend it out with far fewer rules. They offer massive loans very quickly, but often at floating interest rates.
So these private funds are essentially acting as an opaque ecosystem for highly leveraged debt.
Exactly. They are the ultimate breeding ground for speculative and Ponzi finance. Because these shadow banks don't have the same transparency requirements as traditional banks, no one really knows how bad the underlying loans are.
It's all hidden under the hood.
Right. When the poker table runs out of cash, the contagion starts in these private credit markets where regulators cannot see it until it is already spilling over into the broader economy.
Man, that shadow banking contagion is exactly what makes the current tech landscape so precarious. Everyone is looking at the AI boom right now and saying, oh, this time is different. But when I look at the AI infrastructure build-out, I cannot help but think of the 1999 dot-com bubble. Are we seeing that same kind of euphoria phase right now?
The data suggests we are mirroring it perfectly. If you look at media analytics, the frequency of headlines combining the words AI and bubble has recently matched the exact panic levels we saw in late 1999.
That is wild.
But the sheer volume of money involved today makes 1999 look like a neighborhood lemonade stand. Let's look at the capital expenditure, or CapEx. In 2025, big tech, specifically Amazon, Alphabet, Meta, and Microsoft, dropped somewhere between $380 and $410 billion just on AI infrastructure.
Just on infrastructure.
Yes, we are talking about physical data centers, custom silicon chips, and the massive power grids required to run them.
$400 billion is a staggering amount of money for a single year.
And it is accelerating. The projections for 2026 show that spending is going to violently spike to between $650 and $700 billion. Amazon alone is projected to account for $200 billion of that total. This is an unprecedented debt-driven infrastructure build.
Unbelievable. Now, we mentioned Ponzi finance earlier. I keep hearing whispers about something called circular financing happening between these big tech companies and the new AI startups. What does that actually look like behind the scenes?
Okay, imagine a scenario where a massive big tech firm takes $1 billion and invests it into a shiny, newly formed AI startup.
Okay.
That startup suddenly has $1 billion in the bank, but they need massive computing power to train their language models. So they turn right around and use that exact same $1 billion to buy cloud computing services from the very same big tech company that just funded them.
Wait. So the big tech company gives the startup money, and the startup immediately gives it back to buy server space.
Exactly. And on paper, the big tech company gets to report that $1 billion as legally recognized booming cloud revenue.
Oh, wow.
Wall Street cheers, the stock price goes up, and the company uses that inflated stock valuation to borrow even more money from the shadow banking sector. But structurally, it is an illusion.
Because the money just went in a circle.
Right. It is a closed loop of money just changing hands to create the appearance of exponential growth. It relies entirely on new money continuously entering the system to sustain the valuation.
But eventually, these AI tools actually have to generate real-world profits to pay off the hundreds of billions being spent on data centers, right? What does the gap between the expectations and the reality look like right now?
Bain & Company recently released some incredibly sobering data on this. To justify this historical level of spending and to cover the massive power consumption, these AI facilities require AI applications need to generate $2 trillion in new annual revenue by 2030.
$2 trillion.
Yeah.
Every single year.
Yes. But currently, the actual tangible revenue generated by AI software and tools is only in the tens of billions. Microsoft, as an industry leader, is pushing to hit around $25 billion in AI-related revenue by the end of their 2026 fiscal year.
Which is great for them, but nowhere near $2 trillion.
Right. That is a fantastic number for a single product line. But when the entire industry needs to hit $2 trillion, the gap between the expected payoff and the current reality is a canyon.
So what happens when the companies funding this realize the math isn't adding up? What is the trigger that forces the poker player to show their cards?
We are already seeing the trigger show up in the quarterly financial reports. Companies like Meta and Microsoft are showing signs of severe free cash flow pressure.
Why is their cash flow shrinking?
Because AI servers do not last forever. They burn out quickly under heavy computational loads. The depreciation costs are massive. These companies are spending so much capital just to maintain the infrastructure they already built that their actual free cash is shrinking. That pressure is forcing them to quietly cut back on stock buybacks and dividends.
Right. And even if the AI algorithms don't get greedy, the investors funding them absolutely demand a return on their capital. If the cash flow dries up, the whole debt leverage structure starts to shake.
Exactly.
Which brings us to the match that has just been thrown into this room full of highly combustible AI gas. Let's talk about the geopolitical side. And for you listening, when we look at macroeconomic shocks, like the current situation with Iranian airstrikes disrupting the Strait of Hormuz, we are looking at this strictly through the lens of supply chains and financial data rather than taking any political stance.
Right, no bias here.
Exactly. Our core value at Sip&Talk is objective analysis. So setting politics aside entirely, what does the data tell us about this conflict?
Objectively, the Strait of Hormuz is one of the most critical energy arteries on the planet. With the current disruptions in March 2026, approximately 25% of the world's oil and natural gas supply is directly threatened.
25%?
Yes, and the immediate impact is already visible on the trading floor, with Brent crude oil pushing past $80 a barrel.
Now for the listener trying to connect the dots, how does a geopolitical conflict in the Middle East crash an AI data center in Silicon Valley?
It all comes down to inflation. When energy prices spike, the cost of transporting goods, manufacturing chips, and powering data centers all spike. And when inflation runs hot, the Federal Reserve is completely trapped.
Because they can't cut rates.
Right. They cannot cut interest rates to provide relief to the market, because doing so would just make inflation worse. Remember all that speculative and Ponzi finance happening in the shadow banking sector we talked about?
Yeah, the private credit funds.
Those tech startups and private credit funds desperately need interest rates to go down so they can afford to roll over their massive debts. If an oil shock keeps inflation high, rates stay high, and those highly leveraged companies begin to default on their loans.
And it's all connected. So if we know the setup, how do we spot the actual Minsky moment before the general public wakes up to it? You always say we have to look at the plumbing of the financial system.
Yes. The repo market is your 48-hour early warning system. It is the underlying plumbing where banks lend cash to each other on an overnight basis to meet their reserve requirements.
Let's translate this repo market plumbing for everyone listening. What exact dials on the dashboard should we be monitoring right now?
There are three specific pressure gauges. The first is the spread between SOFR, which is the secured overnight financing rate, and EFFR, the effective federal funds rate.
Just to confirm, we pronounce that first acronym, SOFR, correct?
SOFR, yes. Let's break down the mechanics. SOFR is the cost of borrowing cash overnight when the loan is collateralized by United States Treasury securities. It is a secured loan. EFFR is the rate banks charge each other for unsecured overnight loans.
Okay, so secured versus unsecured.
Normally, these two rates are practically identical, but if SOFR suddenly jumps 10 to 15 basis points above EFFR, it is a massive red flag for the entire global economy.
Why is that spread so dangerous?
Because it means the financial world is upside down. It indicates that banks are refusing to lend cash to each other even when the borrower is offering the safest asset on earth, United States Treasuries, as collateral.
Wow.
Yeah, if banks won't take U.S. Treasuries in exchange for cash, it means absolute panic has set in, trust is gone, and liquidity is freezing solid.
That is terrifying. What is the second gauge we should watch?
The Federal Reserve's SRF, or Standing Repo Facility. Think of this as the emergency fire hydrant for the banking sector. If usage of this facility suddenly spikes over $500 billion, it tells us that private banks are in full emergency mode.
They bypass the regular system.
Exactly. They bypass the private market entirely and run directly to the Federal Reserve for cash because the interbank lending system has completely stopped functioning.
And the third gauge?
The reverse repo market, or RRP. This acts as the financial system's safety buffer. It is where excess cash is parked. If we see this buffer drain below $500 billion, it means the market has no shock absorbers left to handle external surprises.
Surprises, like an unexpected airstrike, disrupting global oil supplies.
Precisely. If the shock absorbers are gone, every single bump in the road breaks an axle.
This brings us to the most urgent part of today's analysis. I know you, the listener, are sitting there looking at your retirement accounts, reading the news about inflation and AI, and asking, is it time to panic sell everything?
Which raises an incredibly important point about market psychology. Professional investors don't panic sell, they engage in risk rebalancing. Think of it like driving. You don't abandon driving altogether just because it starts raining. You simply change the type of vehicle you are driving to match the weather conditions.
I like that analogy. Let's look at the actual dashboard right now as of March 2026 to see what the weather looks like. We have 3 distinct lights on our dashboard. Let's start with red light number 1, the SOFR spiking and liquidity freezing. Where are we currently sitting?
I would categorize this gauge as yellow. The market is actively digesting the war news and the subsequent oil shock, but the plumbing hasn't broken yet. Liquidity hasn't totally dried up. Banks are definitely nervous, but they are still lending to one another. So we advise caution, but there is no full panic on the plumbing side yet.
Good to know. Moving to red light number 2, the narrative break in AI. How is market sentiment holding up against reality?
This one is flashing red. If you look at the tech giants, companies like NVIDIA are consistently beating their quarterly earnings expectations and delivering incredible revenue numbers. Yet their stock prices are either flat or actively falling on the news.
It's crazy because a year ago, if a major semiconductor company beat earnings by a single dollar, the stock would surge 10% instantly.
Right, and when spectacular news no longer pushes the asset price up, it means the euphoria phase has exhausted itself. The speculation has maxed out. Everyone who was going to buy into the hype has already bought in, and there is no new money left to drive the price higher. The narrative has officially broken.
Which is devastating for anyone relying on Ponzi finance to keep their shadow banking valuations afloat. Now for red light number 3, the macroeconomic death cross. And to be clear for our listeners who follow technical trading, we are not talking about the standard stock chart indicator where a 50-day moving average crosses a 200-day moving average.
Right. We are looking at a real-world macroeconomic collision of energy prices and bond yields. This indicator is also glowing red. We currently have Brent crude pushing past $85 a barrel, while simultaneously the 10-year U.S. Treasury yield is spiking past 5%.
What does that specific collision mean for the companies operating in the broader market?
It means the Federal Reserve is completely trapped. They cannot come to the rescue with rate cuts to save the tech sector. For all those over-leveraged companies and private credit funds relying on cheap debt to survive a 5% Treasury yield is a death sentence. The cost of borrowing capital is simply too high to sustain their business models.
So if the dashboard has 1 yellow light and 2 glaring red lights, let's go back to your car analogy. What is the actual strategy right now?
You don't jump out of a moving car, but you absolutely need to switch vehicles. Right now, a lot of portfolios are strapped into a gas-guzzling, high-leverage supercar. These are the AI concept stocks, the startups, with zero free cash flow, the companies trading at 100 times their future imagined earnings.
Right, and that supercar is incredible on a smooth, sunny track.
But the macroeconomic road is about to get incredibly muddy and filled with potholes.
So what's the move?
So you trade that supercar in for a rugged off-roader. You rebalance your risk into companies with bulletproof cash flows. You look for businesses providing absolute necessities, energy consumer staples, healthcare. You want companies that make actual profit today, not promises for 2030. You want assets that do not rely on rolling over debt to survive the next quarter.
You essentially want the companies that are operating entirely in that first stage of Minsky's model hedge finance. They can pay their principal, they can pay their interest, and they do not care if the shadow banking sector shuts off the credit line tomorrow because their daily operations are profitable.
Exactly. Surviving a Minsky moment isn't about perfectly timing the absolute bottom of the market crash. It is about making sure you aren't holding the speculative debt when the music stops and the liquidity vanishes.
That is such a vital perspective for all of us trying to navigate this financial madness. Now, as we wrap up this session of Sip and Talk, we want to leave you with one final, slightly chilling concept to ponder on your own.
Yeah, when we look at all these complex systems, the shadow banking loans, the AI capital expenditure, the geopolitical shocks in the Middle East, we always assume there is a solid bedrock at the bottom. But consider this scenario. What happens when the ultimate safe haven asset, United States Treasuries, becomes the exact instrument that triggers the next massive liquidity crisis.
How would that happen?
What if the shadow banking system has soaked up so much leverage that no one has the actual cash liquidity left to buy those treasuries when the government needs to issue them?
Man, if the safest asset on Earth becomes a catalyst, simply because the market plumbing breaks, that is a thought that will keep you up at night. It challenges everything we think we know about where to hide during a storm.
The traditional playbook might not work next time.
It really makes you rethink your entire portfolio strategy. Before we officially sign off, I just want to warmly reiterate our stance today. Our geopolitical discussion regarding the Strait of Hormuz and global energy markets is purely an objective analysis of supply chains and how they impact financial structures. We maintain critical, independent thinking here at Sip&Talk, no matter what the daily headlines are screaming.
We provide the structural data, you build the framework.
Thank you so much for joining us for this incredibly deep discussion today. If you want to keep cutting through the noise with us, please make sure you hit that subscribe button to the Sip&Talk podcast so you never miss an update.
We also want to give a massive shout out to a great friend of the show, Mickey.
Yes. If your brain needs a well-deserved break from the financial madness, you have to head over to his YouTube channel, Mickey to Life. Check out his latest travel vlogs. It is the absolute perfect way to decompress and remember that there is a big, beautiful world outside of the repo market.
Highly recommended for a mental reset.
All right, Sip&Talkers, stay smart, stay rugged in those off-roaders, and we will see you next time.
Take care, everyone.